Today is September 6th, and we are here to discuss the breakdown of the Bank of Canada announcement made earlier today and its impact on interest rates, the Toronto real estate market, and what we can expect to see this upcoming fall. We have a lot to discuss and unpack, so let's settle in as this is going to be a barn burner. Joining us today, we have special guest, friend of the pod and Fox Marin, rockstar mortgage broker himself, Jason Friesen, who's a managing partner at Outline Financial. We have Jessica Spillas, VP Sales here at Fox Marin, aka the Queen of Acquisitions. And we have none other than Mr. Ian Busher, VP of Sales at Fox Marin, who was once referred to, legend has it, as the hottest man in Toronto real estate. We will let the viewers be the judge on that one. If you like to comment and keep abreast of all things Toronto real estate, please be sure to hit that subscribe button down below. And if you have any comments, we'd absolutely love to hear from you. So, okay, let's get into it. Jason, what happened today and why is this announcement so important?
First off, I think the title actually for Ian was the most handsome man in Toronto real estate, just to be clear.
Well, actually, Jessica,
Jason's the hottest. Yeah, most handsome, hottest. Yeah.
Thanks for having me on the pod, guys. I'm excited to be here. Yes, finally a piece of good news with respect to interest rates. It's obviously been a long, I guess we're a year and a half now of constant rate hikes. And after seeing two rate hikes in June and July back to back, the Bank of Canada took a pause. We don't know if this is it from a rate hike perspective, but at least they are on pause, which is a welcome relief to variable rate borrowers, people with lines of credit, loans, credit cards, things like that.
Awesome. And Jason, was this something that you anticipated? There was a lot of, it seemed like a month ago, it was almost a done deal that they were going to raise again. And then a lot more data came out showing that the economy was slowing. There were some job losses. And then it started to seem like it was becoming much more anticipated that they would pause, at least for this announcement in September. Was this something that was anticipated, and what were you expecting to hear today?
I think this definitely was something that was expected as we saw, unemployment numbers start to creep up last month, and then seeing the GDP numbers come in a little bit lower than expected on Friday. This started to become more of a reality where they were going to take a pause. It looks like if you're looking back over the last week, so fixed rates are loosely tied to what bond yields are doing, which are basically a forward kind of prediction of where the overnight lending rate in the economy as a whole will be. And it looks like we started to see that most bond traders were pricing in that things would stay flat instead of increase as they were expected to. We ended up seeing the pause. Now, with that being said, keep in mind the Bank of Canada has left the door open for more rate hikes if needed. So they have not closed the door or given any guidance that leads us to believe that at this point they're done raising interest rates.
Just a comment here. I think they were off a little bit more than a little, projecting 1.5% GDP, and it actually showed that it contracted below. So I think they were way off, and I think they've been way off on a lot of things, but that's just my personal opinion, and we don't necessarily have to dig into that too much. It's just such an interesting time because prior to a year and a half ago, nobody would be like stopping or watching. Like we had a team meeting and everyone was looking on their phones. What did they do? What was the announcement? Like it's such an unusual climate right now to see everybody hanging off of every word that's coming off of these statements and the tone. And I know we were looking at this as being a leading indicator for what we could expect to see in the fall market. But how are you guys looking at this announcement, and how are a lot of our buyer clients sort of taking this? If either one of you want to jump in and answer, I'd love to hear from both of you.
I think this one was far more important than some of the announcements that preceded us, because I think everyone was bracing themselves for interest rate increases last year, but I don't think anyone expected there to be so many. If you go back in time and read some of the projections from some of the leading economists in the world, not a single one of them was accurate in what we are seeing today. And I think for the most part, people have continued their spending patterns and habits. But with the most recent rate hike, I think that did create a little bit more of a shock and create a little bit more of a pause to people's, just in general, their spending habits. And I think for the first time people are really having a hard look at their finances and realizing that they're in a tight position, which is why we're seeing more tenanted properties up for sale than we ever have before. And I think part of the reason why this interest rate announcement was so much more important than some of the ones that followed is because for the first time, we're feeling that tightness. And if there was an increase today, I think that would set a lot of people over the edge. And so I think that's why this one was far more important than the ones that followed, because we're already at a very extreme time. And I'm not sure how much more we can handle as an economy.
It's really interesting because the Bank of Canada is supposed to be independent from political pressure. And yet we are now seeing the BC Premier, the Ontario Premier, and the Newfoundland Premier all writing letters and making public statements about this, just talking about how much stress and duress they're feeling their constituents are under. That is just, as a precedent, really, really interesting because the two really aren't supposed to mix. Ian, any thoughts or sentiment?
I was going to say that surprisingly today, I spent more time talking to potential sellers than buyers. And it was interesting that all of them are celebrating this as a big win as well, because in markets of past, the sellers didn't worry about what the buyer sentiment was. And now sellers are saying, how do the buyers feel? What are the buyers doing? Because I'm getting nervous about putting my property on the market. And they're all basically saying this is a big win for me because hopefully this in turn will give the buyers the confidence to come forward with healthy offers for my property when it's available 2 weeks, 4 weeks, 2 months from now. So I thought that was really interesting that probably more sellers than ever are paying attention to this.
This would have been, I think, the straw that broke the camel's back had rates gone up as far as the psyche of both buyers and sellers. I feel like everyone was on edge. It's almost like you're watching the Super Bowl or something. Everyone's waiting for this to happen. Like it's like must watch TV. Everyone's tuned in to see what the Bank of Canada is doing. Like how many people, a year ago thought about inflation or what inflation was or followed unemployment numbers or anything. And now this is like the general kind of consumer, the general population, this is having an impact on their day to day. And now they're definitely more in tune with this, right? So I'm happy that they left it flat because I think the impact, the psyche would have been really damaged. It hurt in both June and July. I think this would have just been like the icing on the cake as far as, potentially, pumping the brake or putting the brakes on as far as kind of where the fall and where real estate maybe went as a whole, right? If we saw another hike.
It's interesting because when having seen 500 or 450, 500 basis points increase from where we were so quickly, I would have thought that it would have froze the market, and it never really did. And what we really saw, which was interesting, is as there was uncertainty about raising interest rates, that's when the market got really sort of sketchy and got really sort of soft. But as soon as there was certainty, as soon as there was a pause at any level, the market just resumed because people felt comfortable in an environment where they could make the decisions. And it's this level of uncertainty. Are we in a recession? Are we not? Is it a hard landing? Is it a soft landing? Should I spend my savings? Should I invest? Should I not invest? Should I go out for dinner at Bar Italia? It's such a weird time right now where people have to make all kinds of decisions in all this uncertainty, which I think is really giving them a moment for pause.
One thing I want to add is that for the first time, my buyer clients were feeling enormous pressure to purchase something before September in anticipation that there would be an interest rate increase. And I can tell you that today, a lot of those buyer clients who haven't already purchased something, thankfully most of them have, are feeling very relaxed now and also almost relieved that they didn't make a hasty decision a couple of months ago based on next to no inventory, just solely based on the fact that they were forced to do so in order to avoid a higher monthly rate.
And what are your guys' predictions? Like I've read statements coming out of CIBC head economists, BMO head economists. They're basically saying they're done while they're leaving a window open, the bank. And it's important as well, not just what the bank does, but what the bank says. And if the bank is like, we're paused, that could be an inflationary statement in and of itself. But they think that a lot of the indicators are softening and look to continue to soften. And they think that the bank should be done. When for higher for longer or for how long is a different sort of discussion. but they think we're kind of at the end game of the cycle. So, Jason, I'm wondering if you could give us your opinion on that and how you're speaking to clients about that.
For sure. I mean, the statement from the Bank of Canada was very much a wait and see approach, and that they're resolute in bringing inflation back and price stability back to Canadians. So I think what they're basically doing is trying to keep a little bit of fear there that they will continue to raise interest rates, because to your point, the last thing we want is, okay, we're done, and all of a sudden, housing market takes off again or something. You know what I mean? Like, I think they're trying to make sure that they are managing this and steering this in, to a point of a soft landing and trying to bring that inflation number back. So anything they do could be seen as inflationary by giving any kind of hint that we are done. And keep in mind, obviously, we are still very much tied to the U.S. economy south of the border as well, right? So, I think that's something that we need to be mindful of, when we're looking at, where we are as a whole with our economy slowing down at the same time. It looks like the U.S. economy is doing quite well as well. So, I think if we're looking at what clients, the best thing to do for clients and how I'm advising clients is, let's hope that we see lower rates down, kind of in the short term. But at the same time, we have to plan and move forward based on what we know, which is the worst case scenario, which is today. I'd probably say that for the most part, we have a lot of clients that are opting for kind of short to medium term fixed rates. So 1, 2, 3 year terms. A lot of clients are steering clear of the 5-year, simply from the point of view that, the expectations when you look at what the banks are forecasting rates, where rates are going to head over the next couple of years. For the most part, we take the big 6 banks and we've tracked what their economist forecasts are. And we're seeing anywhere between 0.75 and 1.5% lower by end of 2024, start of 2025. So if you were to lock yourself into a 5-year fixed, and then all of a sudden 2 or 3 years from now, rates are 2% lower than they are today, or 1% lower, the longer the term from a fixed rate perspective, the higher the penalty to break out of it. So you'd find clients in a situation where, you're stuck paying this high interest rate for 5 years because the other option is breaking it, and the interest savings are completely negated by the penalty that you'd be paying. So I think, there's a bit of, obviously a risk with going shorter term, but I feel like that is probably at this point, looking, as long as 3 years, I think it puts you in a good spot to hopefully renegotiate when rates are expected to be at a lower level.
Back of the napkin number question here for you. What would you say the percentage of clients right now that you have that are getting mortgages are going variable today versus, let's say, a year and a half ago before the rates started going up? Are people still actually getting variables right now?
So now, with us hopefully moving towards the end of these rate hikes and the potential for there to be rate cuts next year, coupled with the fact that fixed rates for the most part are sitting in the 6s, over the last probably 2-3 weeks, I've had more clients inquiring about variable rates than I did probably in the last 18 months of rate hikes. So there actually could potentially be a great opportunity for someone to get into a variable rate right now, so that they're not locking into such a high fixed rate. For example, you might be looking at a 3-year fixed rate, and it really depends on the client situation, because insured or conventional mortgages are all priced differently. But you could have someone locked in at, say, 6.3% for a 3-year fixed rate, or you could take a variable rate and your rate is 6.2%. So it's slightly lower, but you wouldn't be taking it just for the interest rate. What you'd be taking it would be with the expectation that you do see rates come down in the next year. So that 6.2 could be 5.2 by, time 2025 rolls around. So there could potentially be some interest savings. I'd say right now that 85 to 90% of our clients are taking terms of 3 years or longer on the fixed rate side, whereas kind of rate hike cycle starting in March of 2022, it was probably about 60% fixed and 40% variable rate.
That's an interesting question right now. Like, as we're feeling like we're at the tip, would you? I kind of feel like I would.
Yeah, I would. Myself personally.
Jess, would you, if you were closing on a property today, what would you do? Fixed or variable?
I'm a risk taker. So
I know you are. I already knew the answer to that question.
I would probably do,
Ian?
yeah. Mm-hmm.
I have something coming due in May of next year, so I'll be watching it like a hawk. But it's interesting for sure to jump on for the ride down instead of locking in and staying put for 3 years instead. I'll have to weigh the circumstances. But if I had to do one today,
yeah,
I would monopolize half an hour of Jason's time to compare. I definitely take it into consideration for sure.
Jason, what's it like being a mortgage broker in this environment? Like, I can imagine, like, we're getting lots of calls from stressed clients and people trying to navigate and make a decision. Going back to the idea of being in uncertain times, like, how have things changed for you day to day, and what are you seeing? Maybe more on the personal side with conversations that you're having with people.
I think one of the things that I've always done is connected with clients, and it's a big step for someone purchasing a home or even just refinancing. You're talking about your finances. It's always a stressful time. So I always try to relate and connect with clients. So it's not just completely transactional the way that I run my business. It is very much, relationship based. So I've had tons of conversations with people, and a lot of people have explained hardships that they're going through. It's a stressful time right now. It definitely is a stressful time, just trying to make sure that we work out any options that may be, possible from a lender perspective if a client is in, kind of hardship. It's not one of those things where the banks are just, deferring payments and things like that, like they were when COVID started. But if a client is in a tough situation, there are potentially some options with lenders. So just trying to help them navigate that, looking if there's anything to do to potentially even extend out an amortization, just trying to really understand each individual circumstance and see if there's a solution that we can do or that we can work through to try to help them. It's I feel like both real estate and mortgage brokers had a really sexy job in 2021 when things were crazy busy. And, I think, where we're at today, it's definitely a very stressful job and something that I personally take home with me. I think I hate hearing clients in tough situations. And that's why, again, seeing this interest rate pause at least, and hopefully, us being done raising rates, I think will be great for a lot of people's psyche. I think there's a lot of people that'll be sleeping a lot better tonight. But it is definitely stressful. There's a lot of uncertainty to your point. Once, the Bank of Canada does signal that rates are done increasing, I think it will change the minds of the mentality of a lot of borrowers, both buyers and sellers. But until that point, there still is that bit of anxiety that's still there and kind of the pit of your stomach wondering what's going to happen next.
It's interesting. We were talking about this in our team meeting, and we have like probably 5 or 6 different proposals or conversations all right now going through lawyers because one party isn't talking to the other party. It could be divorce. It could be estate. We've never seen that before. And I think it's really good example of just how people are feeling the stress, and financial is very connected to emotional. And I'm fielding a lot more emotional calls with clients, far more so than we ever had. And it goes back to what you're saying, Jason, about being very personal. And I think with your relationships with your clients, and I think that's why we're all very aligned and we work as a team very well with you. You're almost an extension of our team, I think, because of that. But you really, really feel it, like it's palpable. Jess, do you want to comment on that, like what you're seeing and what you're feeling in communication with a lot of our clients?
Further to Jason's point, I would say that this year has been far more difficult than the years prior, in the sense that the best word I can use to describe it is just everything has been a grind. So even though we are coming close to the sales volume that we've achieved in years past, I would say that I'm doing double, triple, quadruple the amount of work to see that transaction go through because of all the inherent risks that our clients are now facing, both for buyers and sellers. We have far more due diligence that we need to go through, and our fiduciary duty to our clients in order to protect their best interest is so top of mind now more than ever. I recall in 2021 when, Jason, you talked about everything looking fantastic and everyone was having their best year. We didn't really feel a lot of stress when it came to people's financial situation. Everyone was more than approved. They had fantastic credit. They were ready to go. And I would say now for the first time, we're seeing people in very tricky situations where their ability to purchase is directly impacted by interest rates and directly impacted by prices. Whereas before, if prices went up 50,000, 100,000, people were riding the wave. And now we're seeing people's ability to purchase immediately impacted by that. And so the level of research that we need to do, especially when it comes to pricing, is so important now more than ever.
100%. And Ian?
Yeah, I would agree. I was going to use the analogy that it was all tailwinds in 2021, right? Everybody was being pushed forward, sellers and buyers alike, where it was easy, smooth sailing. Everything was pretty straightforward. And now the wind is out of everybody's sails, and there's a lot of ships out on the water that are rudderless. And that's where we come in, is we want to be helpful and we want to provide direction. And Jess is absolutely right. I think there's a lot more hand-holding, conversation, therapy. Jason, you mentioned having to hear about some really tough situations people have gotten into, and we do the same thing. And I think there's 3 times the amount of conversation for every client, just to make sure that we've crossed every T, dotted every I, looked at every option. And Jess's comment about pricing is also extremely valid. It's now, so important when we're selling. We're not seeing people throw another $100,000 at something because money is so free, cheap, easy, fast. Everything is done in a calculated, precise kind of way. And that's what we're looking at. Is we have to show our value and prove our worth and protect our people. I think all of us, everybody on this call.
Totally.
If I could chime in there, the one thing that I notice when I'm working with a client that's a Fox Marin client is how detailed the pricing analysis is done by your entire team. Every person on your team is doing the exact same due diligence for their clients. And it's like, you're not just sending a client out to figure it out on their own and pray for the best and hope the appraisal comes back in fine and on the money. You've really done your homework and have dug deep and really are advising your clients the true way that a realtor should. It's not just, hey, can I get this sale? It's like, I want this client to purchase this house if it makes sense. And here's the numbers. And we've gone through it and we've double checked it and triple checked it, so that I know if you're sending a client over and you think the value is going to be fine, the appraisal almost always has no issue at all. You're doing that homework. You're practically acting the part of an appraiser before the property is even viewed by one. I know that there's not going to be any concern. So that's something where I think, the Fox Marin team as a whole are kind of, prove their worth with their clients for sure.
That's awesome, Jason. Thank you. I'm sure everyone on our team who's watching this is smiling because it's important to us. And I think you also raised like a really good point that I think sometimes people overlook, especially at the early stages of buying, and how important it is to work with a mortgage broker versus a bank, which is a whole other conversation. But we always truly value working with a mortgage broker. And obviously we have a long established relationship with you, and we consider you to be top of the game as a mortgage broker. And you're just so wonderful to work with. But stepping back a little bit and just giving advice to a buyer, I think it's really helpful when the real estate agent or team that you're working with has an excellent relationship with the mortgage broker. And having that line of communication is really beneficial to anybody who's looking to buy in this market. And it's not something people readily think about. They think, I'll just get a real estate agent or I'll just get a mortgage broker. But having that kind of synergy with a team behind you in a market like this is really important. And I think that's something that everybody should consider.
I actually have an excellent story to share that me and Jason encountered over the weekend. Ralph, I'm not sure if you know this, but I think it's an excellent addition to what you were saying, is that we were representing the buyer and she was working with Jason on the financing end. And when we submitted our offer, Jason had pointed out that he had a relationship with the listing agent and that she already knew Jason's level of expertise and had a certain level of trust that all of Jason's clients would be far more prepared when it came to the financials than say, a regular bank that may not have given their clients all of the information that they needed to know. And I was sure to mention in our offer submission that our client was working with Jason, and the listing agent said, "Thank you for mentioning that, because that imbued so much confidence in my seller client that this person is not going to have any issues closing, because I know that they've been pre-approved appropriately and they're operating within the bounds of their means based on who they have representing them, being myself and Jason." So I thought that was fantastic.
That's awesome.
Awesome.
Love it. Love it. Love it. Love it.
Great.
Well, thank you for sharing that. So I'm going to turn the dial in a bit of a different direction right now and throw this at Jason. And it's one of the things I was wondering, especially a year ago, thinking about what life could be like in a climate with interest rates as high as they are today. You know, Jason, who right now is qualifying for a mortgage? Like with the stress test, you're looking at around 8%. How are buyers functioning and looking at this, and who's getting financing with these type of rates in this climate that's changed so dramatically?
I'll actually just give you a little. I ran a scenario today so let's just say we take a couple with a combined income of 150,000. In 2021, that couple, say they have no debts, would have qualified for about 800,000 as a mortgage. So if they had 20% down, it would be $1 million purchase price. Today, using a rate of, a stress test rate of, call it, 8.25, that same borrower is qualifying for about $585,000. That's with 20% down, a purchase price of $730,000. So that mortgage amount, the difference between 810 and 585, it's a reduction of about 28% in purchasing power. You can see, obviously, that's a pretty significant impact on qualification. At this point, what I definitely am seeing are less tire kickers, if you want to call them that, less people just reaching out to kind of just see where they're at, and definitely people that have either done their homework or are potentially looking at, time to buy being right now, potentially being an opportunity. But people that are definitely serious, that have done their homework and have all of their ducks in a row, what I'm seeing a lot is that borrowers that are reaching out, we do the pre-approval, and 3 days later they want to make an offer. It's not like, 2 months later they're still looking. It's like people are getting ready to make an offer and wanting to move quickly on it. So the number of borrowers that are reaching out definitely has dropped, but I'm seeing more serious borrowers. So seeing more activity from people. I guess the sales cycle, if you'll call it that, from start to finish is definitely much faster than it has been in years past. So I think that's just, to me, showing that, people are looking, some people are looking at it as an opportunity to get into the market with, I think prices being down slightly, month over month the last couple of months. I think they were just down slightly 3% between July and August. I think some people are looking at it as an opportunity and still looking at this Toronto real estate very bullish long term. So, looking at getting in while prices are, kind of at least flattening for the time being.
One of the things I've found so interesting in this new reality with interest rates where they are, given where they were prior, is how many cash buyers or how many buyers there are with significant down payments, so much so that they're almost agnostic to interest rates. It's quite astounding. And Jason, or maybe Jess, because I know you've had quite a few buyers in that category. Mm-hmm. Like what is that like, and like what are you seeing with a lot of buyers that are right now out there in this climate?
Well, it's interesting because a lot of our cash buyers came to the table at the beginning of the year thinking that we were at the bottom of the market, and they were trying to capitalize on market conditions. And they were in for quite a surprise when we actually went to start seeing properties and subsequently submitting offers. And we were competing, and prices not only didn't budge from last year, but in some rare instances, they were actually even higher. And so I'm not sure if it's just a herd mentality where a lot of these buyers, this pool of buyers are coming to the table at the same time and then increasing demand and subsequently price points. I've seen people in both categories where they're either coming with full cash to purchase their properties, or the more common factor, the bank of mom and dad, where they're getting a significant down payment from their parents in order to help them cross that threshold. And this is going to be a trend that we're going to continue to see, especially when you hear stats like what you just said, Jason, how most buyers today are qualifying in around 580,000 if they're making under 200,000 as a family income. Like, there's not a lot that you can get with that. That's barely a studio these days. And so when you hear statistics like that, and then you take into consideration the number of transactions that we've seen just across our desk alone, it's pretty clear that a lot of these buyers are either not impacted by the interest rate increases, or they are just coming to the table with boatloads of cash from mom and dad.
I think it's a different conversation. When rates were 1.99% and you were making 6 or 7% on your investments, there was very little incentive to pay down your mortgage or put a large amount of money down. But when you're talking about there being uncertainty in the markets, the stock market, and then at the same time interest rates being in the sixes, that conversation has shifted. It's a much different conversation today than it was 2 years ago. And I suggest to all clients, put down as much money as you possibly can. If you've got additional cash that you can contribute, providing you're leaving yourself with a reserve fund, your emergency fund, your fund set aside for a rainy day, all that kind of stuff, put down as much as you can. If you've got additional cash that you're squirreling away but you're not doing anything with, put it in the mortgage. Listen, down the road, if there's, we see rates, come back down to a reasonable level, and there's something that you need that money for, you could always at that time refinance. But I think at this point, my suggestion would be to try to put down simply just as much as possible to reduce your monthly expenses.
Jason, what is the best advice you would have right now for someone who's considering purchasing a property from a mortgage or finance perspective in this climate? Like, you just take a call from somebody, they're in good financial state of affairs, they're looking at buying. Like, what is a high level sort of advice you're giving people right now?
It always starts with a budget and working backwards from a budget to make sure that your payment fits into your both short and long-term financial plan. From my perspective, I think now is the time to exercise caution and not be overly aggressive. I just can't stress that enough. That's been the message the last, couple of years. I think it just at this point in time now is not, it's not the right time to put yourself in a tricky situation and take a huge amount of risk. So I would just, to my clients, make sure that they're thinking about, going through all of their potential expenses and any expenses that potentially may come up in the future, and budgeting accordingly, and leaving themselves with lots of flexibility so that they're not tied to an extremely high mortgage payment.
And you talk to underwriters and lenders all the time. Like, what is their mood like right now?
So what I will say is, with the number of transactions being down, banks and lenders have much more time on their hands, which means which doesn't always bode well for clients. When things were busy in 2021,
that's interesting.
Things were being approved, left, right, and center. To Jess's point earlier about, 3-4 times the amount of work for every client, the most perfect cookie cutter, if you want to call them that, client that should, and will be approved, still goes through some unnecessary steps, now we're finding. So it's definitely shifted from the perspective that I would say banks are probably their tightest that I can remember them being over the last, 10 years, since right around 2008 when things really tightened up. They loosened up again, and they've definitely tightened right back up. Banks are still giving mortgages for strong borrowers, and there still are exceptions being granted. But if you have credit issues, I'd say credit issues are probably one of the biggest concerns. Banks will look at financial statements to look at income and make some exceptions to different things with income or loan to value on a property. But if you have credit issues and there's credit problems, it's very challenging to get a mortgage right now. And I expect that will continue to be the case. I think, if you're missing payments with your credit, is probably a pretty high indication of your credit worthiness with respect to your mortgage. So if you can't pay a $1,000 credit card on time, how are you going to be expected to pay a $700,000 mortgage on time? So I think the credit worthiness part of it has definitely taken a bigger kind of center stage since we started seeing interest rates go up.
And I'm going to throw the same question over to Jess or Ian, whoever wants to jump in first. Like, what is the best advice or guidance you're giving to buyers who are considering making a move right now in this climate?
Further to Jason's point, I'm also telling them to exercise caution. Don't take risks. Don't go to the absolute depths of your budget. Be far more conservative. When we talk about the pricing valuations that we do, a year ago, it was completely normal to exceed that valuation by X amount. Today, I am very fervently advising people not to cross a certain threshold because the consequences can be dire. And people are already paying far more per month than anyone ever anticipated. And if there are any interest rate increases down the road, that could be the difference of potentially losing their home. And for us, it's all about our long-term relationship with our clients. It has nothing to do with just getting them a property. We want to make sure that that property is going to serve them well long-term. And if we're putting them in a precarious situation and allowing them to do so without giving them all of the information and data, then we're not doing our job.
Ian, is there anything you'd like to add?
Basically, we'll just double down on everything that Jess said. It's really just to proceed with caution. We mentioned earlier, pricing is integral, pre-approval and confirmation of mortgage is integral. Making sure that we are not getting anybody into a serious situation. I do like to defer to professionals like Jason for the financial side of things, but definitely, staying out of debt and kind of reinforcing some things that back in the tailwind year of 2021 and the start of 2022, you didn't have to worry about. So saying more things about the financial side of things to our clients rather than just focusing on the property search.
And I always want to reiterate with our buyer clients right now, do you have something in writing from your mortgage broker? Do you have this in writing? Are you okay to go in on an offer without a financing condition to be competitive? Do you have the assurances that you need? Not just, I think someone told me this or whatever. Like, are you 100% sure that you have that information? Because that information right now is more pivotal than ever with banks being as nervous as they are in this climate. So always make sure you have everything in writing and that you're very clear before proceeding.
I've been asking all of our buyer clients just to connect me directly with their mortgage professional, whether it's a bank or a broker.
Yeah.
And I'm sure to email them personally before submitting any offers with a copy of the MLS listing and asking them to reiterate and confirm, is this person pre-approved for this amount? Are we going to run into any issues? What is their risk level if we submit a condition of finance? And if I'm not having those conversations with those professionals, I am not in a position to allow that client to proceed, because based on their word, they may be confused about the information that they're receiving because they're not the experts.
Well, there you have a great pro tip from the queen of acquisitions herself. So that's a real great one. Thanks, Jess, for sharing.
No problem.
So one of the things that I think that's really interesting right now is that we are in this low inventory crunch, low transaction crunch. Everyone was sort of anticipating that everybody would just be running for the hills if interest rates went up and dumping their properties, and there wouldn't be enough buyers and the whole market would crash. And obviously that never happened. And it seems to be the last thing anybody wants to sell is their Toronto real estate. And they're hanging on because they know the intrinsic long-term value of it. And that's why things have remained so tight. And that's why prices have remained rather buoyant in the face of everything that we've seen. Now, knowing where we're at, which is that the Bank of Canada is not raising rates, and it looks like all of the information is showing that the economy is continuing to slow. And you've got a lot of the heavyweight forecasters like CIBC and Bank of Montreal coming in and saying they think it's done. What are you guys thinking, or what is your best guess of what the next 3 to 4 months are going to look like in Toronto real estate? And I'm going to start with Jessica on this one.
I think based on today's announcement, I think that level of stability is going to encourage people to continue to come out of the woodwork. I think a lot of people would have potentially changed their plans to buy if there was an increase today. And what I have seen just in the last couple of days alone is an influx of great new listings, a lot of it being pent up from the summer months. And whenever we see new inventory coming in waves, so too does the demand. So my prediction is actually going to be that we're going to have a very busy next couple of months. And then as we gear into holiday season, end of November, December, things are going to start to slow down as they have done the last couple of years. And after that, it's sort of a wait and see.
There you have it from the Queen of Acquisitions. Jason, what are you thinking from your lens? And you've been in the business for a long time as well. Like what are the tea leaves reading for you?
I think it's going to be a bit of a roller coaster ride. I think, as far as interest rates, I think, we're going to see, numbers come out and see inflation creep up a little bit. I think the Bank of Canada is not as alarmed about that. It's really, a big, a big portion of the inflation number that we'll get. I think it's the 19th when it comes out. We're going to see an increase. I assume some are talking about headline inflation potentially hitting up to 4%. A lot of that has to do with gas prices. So I don't think that's the only concern that the Bank of Canada is looking at. They're looking at GDP, they're looking at unemployment, they're looking at the economy as a whole. So but because I think everyone's so in tune with this now, everyone's looking at inflation, the average consumer, it will have, impact on the psyche of people, I think. And as we continue to hear these kind of points come out throughout the month, it's going to impact people. You're going to end up getting calls from people. What about this? What about this? What about this? I do think that rates will remain relatively flat, hopefully come down a little bit on the fixed rate side. And I think as long as interest rates are in the sixes, it will in some ways mute the market. I think it, just A, from an affordability perspective, but B, again, getting back to the psyche of the borrower. So I think until we're at a point where we do start to see fixed rates in the fives again, for the most part, just across the board, I think it's going to be active, but not like a typical fall market.
And what do you think that means relative to prices? Up, down, or flat?
I think relatively flat, to be honest with you. I think, potentially maybe a small, drop in average price, but I do feel, again, I'm pretty bullish long-term on Toronto real estate. So, I think, once we do get a signal that rates are done increasing and they are signaling that there will be cuts in the future, I think we'll probably end up seeing prices start to take off again from there.
So, yeah, I think all that's really realistic given what we're seeing and the information that we have. I think one of the things that's so interesting to me is that we are so used to such a fast-paced market here that, if something doesn't sell in 5 days, what's wrong with the property? What's wrong with it?
Yeah,
like, what's wrong with
totally.
it? The property's tainted. If you go to any other major city or, mid-sized city in the world, you will be very hard pressed to see anything that has sold along the lines of the velocity that we see here in Toronto. And so we're very spoiled by that. And so we're always in such an extreme seller's market that as soon as things might become balanced, it's, oh my God, this is the end of the world. And one of the misnomers about real estate agents is they think we want to pump everything up to the moon and we want to, give this sort of thing and have this crazy FOMO. That's the last thing that we want. Any good agent really wants a balanced market. And I think that's the type of market that we're heading into. And I very much welcome that, where things might take 40 days to sell or 35 days to sell. I think that benefits the consumer. And I think as long as the seller is represented and has the reasonable expectations, if they have a great property and it's marketed to the highest of its best potential, they'll do just fine. And so I think we just have to take all of this in context and just be like, it's just a slower, kinder, more gentler market where an actual buyer has the opportunity not just to buy a property, but to buy a property they actually like and want, as opposed to just getting something. So I think there's lots of opportunities out there right now. And I think I very much welcome a more balanced market conditions. And that's really what we're probably moving into, from extreme seller market to a seller's market to probably more balanced scenario. And I think that's just fine. And I think that's really healthy for the market as a whole. But long term, I agree with Jason, and I think everybody on our team understands the long term demographics and the long term supply constraints, which only really show to a tremendous future for the market. And I think if you can take away the nerves and the emotions, and you can look at the past track record, and you can zoom out into the future, prices in the future are going to be a lot more expensive than they are today. And if you have a good mortgage broker and you've got a good real estate agent to work with, they can really set you up on a path for success. So I just want to thank Jason, especially for joining us here today. It's so nice to have Jason as a guest, and I'm sure he'll be back to talk about more interest rate related, inflation related discussions. Jess, always a pleasure to have you on here. And Ian, it was great to have you join us as well. I want to thank everybody for watching this video here. We really wanted to do our best to give a summation of what we're seeing happening right here, boots on the ground. And if you love this information, or you have any questions or comments, please be sure to smash that subscribe button, hit that like button, or comment down below. And we look forward to seeing you again. Thanks for joining.